Well, it's a new year when many of us make New Year's resolutions to lose weight, eat better, or exercise more often. Why am I reading this? But how do the companies that help us keep those virtuous resolutions perform this time of year? Do shares usually rise along with those hopes in January? Dominic Chu takes a look.
'Tis the season for New Year's resolutions. So, can the idea of New Year's resolutions turn into New Year's investing ideas? Over the past 3 years, a few resolution themes stood out. First, physical fitness. Eat better, exercise more. On the diet front, there's Weight Watchers International. During the last 3 Januaries, shares of the company have posted healthy gains. But those gains seem to fizzle out by the end of each full year, along with those diets. It's a different story for the gym rats. Town Sports International, which owns New York, Boston, and Washington sports clubs, among others, posts healthy gains in January, and those gains gather even more steam as the year progressed. Second, getting your finances and investments in order. Take a look at shares of Morgan Stanley. It's posted strong gains on average over the last 3 Januaries, but that's about it. Shares were relatively flat for the rest of the year. Different story for personal finance software company Intuit, which posted more modest gains for the month, but got stronger to finish out each year. And third, for education stocks like DeVry and language learning company Rosetta Stone, the results have been pretty mixed. Some professional investors understand the thinking behind using consumer habits to make investing decisions, but cautioned against relying on them solely.
Forget the fact that we doubt the ability of those making the New Year's resolution to stay committed to it, but really, what would it do to the earnings growth potential throughout the remainder of the year, and thus the ability for the stock to appreciate? It's not going to be in our analysis and our strategy.
The bottom line here is, take a moment before buying a stock just because the company plays a role in your New Year's resolution. For Nightly Business Report, I'm Dominic Chu.
Now to the flip side of those resolution-related companies, to so-called sin stocks. We're talking here about companies behind things like cigarettes, booze, even fatty fast foods. Morgan Brennan takes a look at how these stocks have performed at the start of the new year.
They're certainly not good for your health, but they may be good for your investment portfolio. Sin stocks, these publicly traded companies that specialize in bad-for-you vices like tobacco, alcohol, gambling, even fast food. The negative stigmas attached to these companies have caused more traditional investors to steer clear. But those who have been willing to buy into the bad behavior have reaped sinful returns over the past decade. And when the economy's been bad, they've done even better.
Take Vice Investor. It's a mutual fund whose holdings include such big-name sin stocks as Diageo, Lorillard, and MGM Resorts. The fund returned more than the S&P 500 in 2013, and over the last 5 years, it's beat it by about 10%.
But here's where these sin stocks get even more interesting. With the exception of gambling, these purveyors of vice typically suffer a post-holiday hangover, perhaps due to all those New Year's resolutions. Nearly all of the major multi-billion-dollar companies of the tobacco, alcohol, and fast food industries have on average underperformed the S&P 500 over the past 3 years in January. But it doesn't seem to last. Investors relapse eventually, pushing these same stocks to outperform the S&P during the rest of the year. The only vice that seems to be immune to New Year's resolutions? Gambling, as the major casino operators have all been outperforming the S&P 500 regardless of the season. So while it may feel better to choose the socially responsible stocks, or at least stick to the ones that don't celebrate bad habits, it may just pay to invest in vices, because the January hangover doesn't always last. For Nightly Business Report, I'm Morgan Brennan.